Okay, I'm going to be telling you 5 legal ways to save tax within a pension. And the first thing before I go into this is that, look, pensions are incredibly tax efficient already. And chances are, if you're saving into them, you're already being tax efficient. So well done you. However, like almost everything in financial planning and with tax, there's always ways to be smart with your funds. So in this video, I'm going to be telling you 5 completely legal and practical things to consider to manage the taxation on your pensions. Okay, number 1, spread out the withdrawals. So to understand this, you need to understand that first, in the UK tax system, it works that you're taxed at marginal rates depending on how much you earn, which I'm sure you probably already know. Anyway, our system means that broadly, the more you earn, the more you get taxed, with bands going up from £12,570 this tax year as your personal allowance, then up to £50,270 for basic, and then beyond that you've got your additional rate at 45%. And here's the big issue. From what I see, the people who often are most critical of pensions have this weird self-reinforcing reality where, because they don't understand the rules, they often get burned by them. So what often happens is when they reach the point they can draw on their pension, or perhaps when they retire, they decide to cash it in. And the problem is, though, while it's yes, bird in the hand and not in that pesky and confusing pension, going back to those marginal rates, consequence paying a huge amount of tax that you didn't maybe need to. The thing that I want you to think about here is that, look, if you pay a ton of tax in one year because you've done this, you don't get a refund the next. In the same way that if you earn 300 grand one year and nothing in the next, HMRC don't tap you on the shoulder and go, oh, well, we'll let you off, you paid quite a lot last year. So let me show you in this example. Because the tax implications get bigger the higher the amount, let's take a pretty chunky amount, say £150,000. So here you can see the total tax payable even with taking 25% as tax-free cash from a money purchase scheme. If it's taken over 1 year, the tax bill is £34,000. That's because within that, £68,480 goes into the higher rate tax of 40%. Now, if we were to take a step back and go, well, hold on a second, let's not pay higher tax and let's do this over 3 years. Just in spreading out your withdrawals, you've got that tax down to £15,080. So previously, over 1 year, you would have paid double in tax. So being patient and intentional with withdrawals can really save a lot. Okay, so number 2 is understanding effective rate of tax. And I just want to explain why this is so important. So let's say you've got Jane and she's 59 and she's looking to retire at 60. She's a successful consultant and a high rate taxpayer, and she's built up a reasonable pension. Now, if she were to make additional contributions, she would receive 40% tax relief. And let's say she's aiming for income of £35,000 income in retirement after tax. Why do we need to be thinking about effective tax rates? Well, look, if Jane makes a contribution to her pension of £10,000, she will receive 40% tax relief. Assuming it's a relief at source pension scheme, she'd pay £8,000 into the pension, she'd get £2,000 tax relief up to, say, top you up to £10,000, and then she'd claim the other £2,000 via her self-assessment. So in this example, it cost Jane £6 grand to get 10 grand in a pension. But I know what you're thinking, look, wait, they're going to get taxed at the other end. Yes, they are. However, because Jane's looking to get £35,000 from a fund next year when she retires and she has no income, okay, so she's aiming for £35,000 after tax, and she needs £38,218 to actually get this. So what would happen is, on the withdrawal, £12,570 would sit within her personal allowance and be taxed at 0%. Then just under £10,000 would be tax-free cash, and the rest would be taxed at 20%. That means that the effective rate of tax on that withdrawal is an 8.4% effective tax rate. So while she received 40% tax relief on her pension contribution, her withdrawal effective tax rate was much lower. Now, I want to be clear, across retirement, tax rates will vary because you're going to have things like your state pension kicking in and all the rest of it. So that example might not be the same throughout the entirety of retirement, but that dynamic is still very important to understand, and that's the thing that's key. Okay, just very quickly, I have a special offer to all the good people who watch my channel, exclusive to you, is how to avoid expensive retirement mistakes in my completely free ebook, 5 pension tax mistakes to avoid, showing you the most common retirement tax mistakes and how to avoid them. But it's not just that, you also get a short 5-day email sequence which I'll be telling you the science behind living a great retirement, how to manage your most valuable asset, and at the very end you'll get access to a life-changing retirement masterclass where I will show you step by step the secrets of how I plan for my clients in retirement. The best part, as part of my mailing list subscribers, it's completely free, get access to the ebook and all that in the link below. Okay, so next is the 60% tax trap. And the 60% tax trap is something that affects higher earners, and it's to do with the personal allowance, which is the amount income you can receive each year tax-free. Now, since about 2010, the personal allowance has been reduced by £1 for every £2 of income above £100,000. So if you earn above £100,000, it actually starts getting tapered down. And at the point where your income is over £125,140 or more, the personal allowance will be nil. This actually means that the effective tax rate for incomes if you earn between 100 grand and 125,140 is 60%, because you're not only getting taxed on that income above 100 grand at 40%, but you're also losing your personal tax-free allowance. However, what we do now is through what's HMRC call adjusted net income, and this is total taxable income before any personal allowance and less certain reliefs. And it's those reliefs that I'm really going to target here, because they include things like trading losses, to gift aid, and also pension contributions. And it really is the pension contributions that I'm going to focus on. So remember, once you get to 125,140, your personal allowance is nil. So here is like the total tax and how that fits into the bands, if that is your income. And we can see there's no personal allowance. But now if you make a pension contribution to the difference between 100 grand and 125,140, the pension contribution of 25,140 includes basic rate tax relief. So if it's a personal pension contribution, we're going to assume you paid £20,112. So now if I look at those two figures and the trade-offs that you're looking at to do that, so what HMRC had been paid before you did this compared to what you're now getting in your pension is £15,084. And that actually gives you an effective tax relief of 60%. Okay, so number 4 is to check the death benefit options. And I think this sometimes can catch people out. And it's a grim topic as talking about death benefits. But especially as often people have pensions which span many years back where the legislation was different, the type of benefits that may be offered are likely one of a mixture of cash lump sums, dependents, nominees, annuity, where they have a guaranteed income for life, or dependent nominee and successor drawdown, where they draw down on any income left over. What it means is it can have a big impact on who the money eventually goes to if you pass away. Now, for example, if it goes to your spouse and between the two of you, you are likely going to have an inheritance tax charge of 40% at a later date. This could be problematic if it's paid out as a lump sum, because they might then have to consider gifting or trusts. To the same extent, having an annuity, which is a guaranteed income for life, that could be completely acceptable to someone. But to the same extent, other people could find that because the spouse or dependent is the last one to benefit from the annuity, they might want to take advantage of the fact that some pension options can cascade wealth down the generations. And that's where successor flexi access drawdown comes in. So you've probably figured out that it's really important to be intentional and understand what the death benefits are for you. So to get this right, you need to plan effectively and understand what your priorities are. So it could be that the death benefits are completely irrelevant. However, to the same extent, if you're really concerned on legacy and ultimately your money going through the generations, that could have a big impact on your decision. Number 5, making the most of your allowances. So the most practical tip I can give you is the one that I use most often with my clients, especially in line with point 2 I mentioned earlier, which is just make sure you're making the most of the tax allowances available to you. So the annual allowance for this tax year is now £60,000. So our pension tax system works based on marginal rates of relief, which I've discussed. So the more you earn, the higher you get into those tax bands, and the stronger the argument potentially could be for additional contributions. So for an individual who receives 40% tax relief, they will have a larger pension pot of retirement due to the higher tax relief given. That's because every pound contributed into the pension, the government effectively will add 40p one way or the other. So in contrast, if you're earning less and you've only got 20% tax relief, that means that the benefit from a tax perspective is lower. So you just need to be aware of making the most of your allowances and what your marginal rates are going to be. So often that is literally just a case of getting to the end of the tax year and going, okay, do we have some spare cash? Or, can we maybe push things a little bit harder in relation to our savings regime? And that's one of the key things that you can do to get a better retirement, just that little bit more effort. And yes, you can carry forward the last 3 years from your pension allowances, but you might not have relevant earnings to take you into the higher rate band when you do that. So that your earnings position in the next few years on the build up to retirement is important to bear in mind so that you benefit from the most tax relief possible. So as useful as those 5 tax tips have been, many people don't actually understand how much they can put into a pension, which in fairness is really quite complicated. So I just mentioned relevant earnings. You might be thinking, well, what are they? That's why if you're thinking about retirement, you really could do with watching this video so you can understand that.